Hello everyone. Welcome to our Chapter 5 video lecture. The focus is on how to account for receivables and inventory cost flow. So you ready? Let's go. So in Chapter 5, we'll first talk about what's known as uncollectible accounts expense. Perhaps you're saying, well, what is that? You'll learn more about this expense as we go through our Chapter 5 presentation. When a company allows customers to buy now and pay later, the company's right to collect cash in the future is called accounts receivable. So if a company provides a service or sell a product and allow the customer to pay them later, that means they provided a service on account, and they have an account called account receivable that shows money that's owed to the business organization. Typically, amounts due from account receivable are small amounts and collected in a short period of time. So the pay may be due in 15 days. Typically, no more than a 30-day period is the common time frame for an account receivable. When there's a longer credit term, meaning that the client has a longer time to pay, typically they issue what's called a note, promissory note, reflecting a credit agreement between the parties. Therefore, if we have to go to court, now we have documentation, and the note has all the terms such as the maturity date, the interest rate if applicable, and other credit terms. So those are known as notes receivable. So typically account receivable is for a short period of time when you extend credit for a short period of time. If the time is longer or if the amount involved is substantial, typically they may make you sign what we call a promissory note, and you have what's called a notes receivable. So we're going to cover in this chapter, we'll cover both account receivable and no receivable. These are both asset accounts that are going to be shown on the balance sheet. Okay? Now, as I indicated, when you allow customers to receive credit to pay for items at a later date, you're not going to collect all the money all the time from all your customers. That just doesn't happen. You will always have a client who's either unable or unwilling to pay their debts as the debt becomes due. So, we have something called the net realizable value of account receivable. This is the full amount we expect to collect from our customers that owe us money. What we're saying here is that, yes, we understand that the clients may owe us $10,000, but we're going to make an estimation that at least one or two clients are not going to pay the amount that's owed. We're going to talk about a new account called the allowance for a doubtful account, which is a contra asset account. The word contra means opposite or against. It's subtracted from account receivable to determine what's called the net realizable value. And we'll go through examples of what this means and how to calculate this net realizable value. For example, here we go. Let's assume a company has total receivable in the amount of $50,000. However, based upon historical information, we estimate that 2,000 of that will not become collected. That 2,000 goes to account called the allowance for doubtful account, which is a contra asset account. It's subtracted from the face value of our receivables to get what's called the net realizable value of our receivable. In essence, this is the amount we expect to collect from our clients They owe us $50,000. We estimate that 2,000 will become uncollectible. So we expect to realize or receive a total of $48,000 from our customers. Okay. Now here you're saying, well, how do we know what portion of our receivables are going to become uncollectible? I am glad you asked that question, and we'll talk about how to do that. So we have a way to estimate the uncollectible account. We have what's called the allowance method. The allowance method requires accountants to estimate the amount of uncollectible accounts. One way of doing this is what we call the percentage of revenue. The percentage of revenue. We're now going to estimate what percent of our revenue do we expect to become uncollectible. Again, what percent of our revenue, based upon historical information, do we expect to become uncollectible? And I get an example of how to do this. Let's go through some actual transactions pertaining to providing a service on account. So we have Allen Tutoring Services, recognized service revenue in year one, earned on account, keyword on account, for $3,750. So we provided services on account, meaning the client has not paid us yet. So on the balance sheet, you'll see an increase in assets and an increase in retained earnings. On the income statement, we see an increase in revenue for $3,750. All right. Next, we collected in cash from those clients $2,750. Remember, they owed us $3,750. So when the cash is collected, your cash account increased by $2,750, and the account receivable account, because they paid us, decreased by $2,750. That transaction doesn't impact the income statement, but on your statement of cash flow, we have an increase in cash as an operating activity in the amount of $2,750. Now, we're going to estimate that 2% of our revenue is going to become uncollectible. So the total revenue was $30,750. 2% of that is $75. So now we're going to make an entry. We're going to recognize what we call the allowance for doubtful account for that $75. Now, it is shown as a negative parentheses because it is a contra asset account, and your retained earnings account would decrease by $75 because you're going to recognize an expense called uncollectible accounts expense. It's sometimes referred to as being bad debt expense. This amount is to estimate that portion of our revenue that we expect is going to become uncollectible. All right. So 2% of 3750 is $75. So that's an increase to the allowance for doubtful account. But again, that account, because it's a contra account, is shown as a negative number, and you recognize the expense, which reduces retained earnings, in the amount of $75. Did you all follow that? If you need to, rewind the video and go over that again. So now let's take a look at how that's going to impact the balance sheet and the allowance for and the account receivable account. So remember that this total sales were for $3,750. They paid us $2,750. They still owe us $1,000, right? But we estimate that $75 will become uncollectible. Therefore, our net value of receivables is $925. To interpret that, we're saying the clients owe us $1,000, but we expect that $75 will not be collected. Therefore, the net amount we expect to receive from our clients is $925. So now you see from year one, this is showing the income statement, revenue minus your expenses. This is showing your balance sheet. Notice that the account receivable, the allowance account, subtracted from account receivable to get your net realizable value. Add to your cash account, statement of cash flow. We had an inflow of cash of 2050, which was shown as an operating activity. So now we're going into year two. Now in year two, $70 was written off as being uncollectible. Now this amount is not an estimation. What we're saying here is that a client is not going to pay us for sure, and now we're going to write off $70. Now notice that write-off is not going to change your net receivable. Why is that? Well, because we estimated that $75 will become uncollectible. So when you do the actual write-off, what happens now is that the account receivable count will decrease by $70, the amount that was written off, but the allowance for doubtful account will also go down by $70 because we estimated $75 become uncollectible. $70 did become uncollectible, so there's only $5 remaining in the allowance for a doubtful account, but your net value is the same before and after the write-off. And again, that's because you estimated 75 would become uncollectible. So far, you've only written off $70. Does that make sense to you? Okay. Now let's look at some more transaction. This time we provided services for $10,000 during year two. And again, provide services on account. So your assets increase, so they retain earnings as well as your revenue. The clients paid us $8,430. So when they paid us, the cash account increased $84.30. The account receivable account decreased $84.30 because they owe us less money. And on the statement of cash flow, we have an increase in cash from operating activities in the amount of $8,430. It says that we recover a receivable that it had previously written off. So we said, remember, we wrote off $70. We wrote off $70. So if you now collect that, it's just going to increase your receipt by $70 and increase your allowance account by the same amount, with the net effect being zero, because you're going to increase the account receivable and increase the allowance for doubtful account by the same amount. Therefore, it has a zero impact on your net realizable value for accounts receivable. Okay? Now, let's say that the $10 that we know, let's say we collected $10. And that was, so we wrote off $70, but $10 was actually collected. Now, when you collect the actual money, that's going to increase your cash account and decrease the account receivable. And on your statement of cash flows, your cash under operating activities will now increase by $10. Okay? This time we're going to write off $200. We estimate that 2% of our revenue will become uncollectible, which is going to be $200. Therefore, the allowance account will increase by $200. Your retained earning, let me go back. Your retained earning goes down because your expense, right? The uncollectible account expense or bad debt expense will increase by $200, which will impact your income statement as well as your retained earnings. I know it's a lot to cover. We're going to come back and continue our discussion on Chapter 5, how to account for our receivable transactions. So stay tuned for Part 2 of our Chapter 5 discussion. Bye-bye.